What's up everyone, this is Yadik, your mortgage expert. My inbox has been buzzing with questions regarding the first-time home buyer incentive. People are asking, what does this mean? I hear headlines that, hey, I can buy a home for cheaper, it costs less, and you know what? The newspapers are clickbaiting you hardcore. Now, in this episode, we're gonna be looking at what the first-time home buyer incentive is, how it can help you, and how the government is gonna get their money back. Stay tuned. So a lot of people are asking, hey Yadik, what is this first-time homebuyer incentive and can I apply for it? What it is a way that the government is trying to help new homeowners decrease their carrying costs on a per month basis. Now, what that means is that they're actually going to pitch in some money for your down payment so that they become equity owners of your home. And as a result of doing that, your monthly costs decrease. But it doesn't help you qualify for a home easier. You just have to qualify as is beforehand. Depending on the type of property that you're looking to purchase, the government in Canada will pitch in either 5 or 10% of your down payment so that your monthly carrying costs are decreased. Now, this is going to become really important when it comes for repayment because the government always gets their money. So to qualify for this program, we have to qualify you as if it was a regular mortgage because that's what it actually is. You still need to get an original first mortgage and this incentive will be tacked on as a second mortgage. So there are going to be 6 main things that we're going to use to qualify you for this first mortgage: income, down payment, residency status, first-time home buyer status, the property, and debt to income ratios. So let's dive into the first thing, income. The first thing that we want to make sure is that your income is good. We need to be able to qualify you for a first mortgage. However, one limitation of this program is that you can only qualify for a maximum of $120,000 of income. You might say, hey Yadik, I make $80,000, so I'm good, right? Well, we have to look at everyone that's going to be on the mortgage. If that's going to be you, your partner, your spouse, and maybe even a co-signer, we're going to be taking all of those incomes and we're going to be adding them together. Those incomes that are going to be on the mortgage have to be less than $120,000. Now, if that is the case, perfect. What you can get is you can qualify for a mortgage up to $480,000. So that's 4 times 120 gives us 480. That's the max mortgage that you can get with this incentive. The second thing that we're gonna have to look at is down payment. The government of Canada is not going to be giving you a down payment. That would be awesome. You have to come up with your own funds to put down on this house. For a $500,000 house in Canada, the minimum down payment that you can do is 5%, meaning you need to bring to the table $25,000 if you're looking to purchase a house of $500,000. This down payment, it can come from a number of sources. The best being your own savings. The other part that you can use is our RRSPs. The maximum withdrawal now for your RRSPs is $35,000, which works because you're going to be bringing a down payment of $25,000. You can also get your down payment from a gift from a direct relative that it's non-repayable. You can't take out a loan and you can't use your line of credit in order to come up with the down payment for this incentive. Now, the third thing that we're going to look at for this incentive in particular is your residency status in Canada. So this one is easy. Are you a Canadian citizen? Yes, qualified. Are you a permanent resident? Yes, qualified. Are you a non-permanent resident that is legally allowed to work in Canada? Awesome, qualified. Now, the fourth thing that we're gonna look at is your status as a first-time home buyer. Well, you're probably gonna say, Yadik, that was probably as easy as the first one. I didn't own a home before, so I'm qualified, right? Absolutely, but there are other circumstances where you can also be qualified if you've owned a home in the past. This is awesome. If you sold your house in March of 2014, you would actually be qualified for this incentive in January of 2019. The other way to get qualified in a circumstance where you've owned a home in the past is if you've experienced a breakdown in your marriage or your common law relationship. The fifth thing that we're gonna be looking at is property. Now, under this incentive, you can purchase a number of different properties. You can purchase detached, townhomes, condos, duplexes, triplexes, fourplexes. They can be resale homes, so a home that somebody has lived in the past and is now selling to you. They can be pre-construction homes or new construction homes, and they can also be mobile homes or prefab homes that will be put on a certain spot. The properties that are not allowed are, number 1, rental properties. But wait a second, Yadik, you just said you can buy duplexes, triplexes, and fourplexes. Isn't that a rental property? Yes, that is. The difference is that for those rental properties, one of those units have to be occupied by you. So it's an owner-occupied rental. Rental, as in strict investments where you are not living on premises, are not allowed. One thing that you have to keep in mind is that some lenders will actually take that rental income and put it as your own income. If that's the case, you have to make sure that it also qualifies under that 120K max income. This incentive is rolled out Canada-wide, but in some markets, it just won't work. And I'm particularly looking at my market that I serve, which is the Greater Toronto area, the Hamilton and Golden Horseshoe area, where detached homes typically go for $800,000, $900,000 and into the millions. So clearly you wouldn't be able to use this incentive on that. But the type of property that you would be able to use the incentive on are condos that are generally less than $500,000. Number 6 that we're going to be looking at are your debt to income ratios. These debt ratios are ever important, and there really is no leeway in their amounts. There are 2 ratios that we use in all mortgage qualifications. The first one is GDS, and it's your gross debt servicing ratio. What it includes is your mortgage payment, which includes your principal and interest portion, looks at your property taxes, looks at a value for heat, and if you're in a condo, it takes 50% of your condo fees and divides it by your gross income. That number has to be less than 39%, meaning that 39% of your gross income is going into paying your mortgage and your carrying costs for owning that home, which includes taxes and utilities like heat. The other ratio is TDS, or total debt servicing ratio. That one takes all the components of the GDS, but also includes any other debts that you might have. Debts like car loans or student loans or credit cards that if you stop paying, the banks would come after you. That number has to be less than 44%. So 44% of your income going into paying your mortgage, your taxes, and your heat, as well as your maintenance fees if you're on condo and your other debts. You have to fit into those ratios. And if you don't, then unfortunately we can't qualify the mortgage at that time. That's when you and I have a conversation and see if we can bring your ratios down by maybe paying off some debts or looking at alternative properties. Unfortunately, one of the things that we can't do is increase your amortization to bring your monthly costs down and then qualify you into the ratio. The maximum amortization for this incentive and for insured mortgages in general is 25 years. Now, if you've never heard this term insured mortgages, it means that you aren't putting 20% down, and so you're going to be using one of 3 insurance companies in Canada to insure the rest of your mortgage in case of default. This insurance is mandatory, and it protects the lender in case of any defaults on your part. There is a premium, and that premium is based on how much down payment you've put in. So if you're going to be paying 15% down payment, your premium percentage is going to be less than if you're putting 5% down payment. That premium is calculated and rolled into your mortgage, so you don't have to pay out of pocket for it, but you will have to pay the taxes on that out of pocket when it comes down to closing. After all of that, if we've looked at every single one of those aspects and we're able to qualify the first mortgage, well, congratulations, we'll be able to qualify you for also the incentive as well. Now, depending on the type of property that you're going to be buying, you're going to be eligible for one or the other type of incentive. If you're purchasing a resale house or a mobile home or prefabricated home, you're going to be eligible for a 5% incentive. If you're going to be looking at purchasing a new construction or pre-construction home, you're going to be eligible for either a 5 or a 10% incentive. Once you've chosen your incentive, it's going to be applied to your mortgage and you're going to see a reduction in your total monthly payments. Now, whether you're doing monthly, or you're doing bi-weekly or weekly, whatever the case may be, you are going to see a decrease in those carrying costs until it comes up for repayment. Okay, so you've had your incentive and now you have to think about, how am I going to repay this incentive? Because the government is not going to give you free money. Let's be honest here. Let's say you purchased your home at $500,000 and you chose a 5% incentive because it was a resale house. The government of Canada gave you $25,000 to put towards your down payment. Let's fast forward 2 years and your property has increased from $500,000 to $600,000. What you're going to have to do is pay 5% of that new fair market value, which is going to equate to $30,000. Okay, so great. So you get this money and now you are holding on to it. You're benefiting from the monthly reduction of carrying costs. But the question is always in your mind, when do I repay this loan? There are 2 very simple answers. Number 1, if you sell the house. Or number 2, if you reach the end of your amortization, which is 25 years. Both of those situations will require a repayment of the incentive in full. Now you can also pay this incentive out at any given time throughout the loan. If you're a baller and you just have, $25,000 laying around, you just throw it in. Absolutely, you can do that as well. But they only take full payments. You can't say, oh, I'm gonna skip my coffee for today and put that into my first-time homebuyer incentive fund. No, it's not gonna work like that. Hey, I wanna do some renovations, increase the value of this house, but I don't wanna pay the incentive on the post-renovation value of the house. So what you can do is you can actually pay off your incentive early, do your renovations, increase the value of the house, and then sell it for a higher price so you don't actually pay for that new value. Most of us won't actually get through one house in 25 years. You might have a chance to renew your mortgage, and when you renew a mortgage, that doesn't trigger repayment. But sometimes you might come into circumstances where you need to pull money out of your house as a refinance. That doesn't necessarily trigger a repayment as long as your loan to value at the time of refinance is less than 80%, meaning that you have 20% equity in the house. What about our two D words, death and divorce? If you own a home with a spouse and one of you passes on because an asteroid came and hit you in the head and you are no longer with us, the other person won't have to repay the incentive at that time. They'll have to wait until the property is sold or the amortization has lapsed. Now, in the case of divorce and one person is buying another person out of the property, if they have funds available that don't require them to borrow any other funds, then no, you don't trigger a repayment. You'll just have to do it again when you sell or your 25 years is up. However, if you do have to take out funds, that will trigger a repayment at that time. So if you choose this incentive, it could actually save you a chunk of money every single month on your carrying costs. This could be put towards other things like reinvesting in your RRSP, paying off student loans or your car, or even buying diapers for your kids. I mean, I got 2 kids and diapers are expensive. So if you want to get into a house but cut your monthly costs as much as possible, and you don't mind repaying the loan at a future value that's undetermined, this might be a good option for you. If you feel this program is good for your financial goals and for your family, stop what you're doing and smash that like button. There is $1.25 billion available for this incentive over 3 years, but it is first come, first serve, meaning that if you decide to purchase a home in 3 years, the funds might not actually be available to you. That said, don't use that information to hastily make a decision and move into a property that is not suited for you. This incentive is not for everyone, and in fact, it actually might cap people at a specific purchase price because of that $120,000 income cap limit. In my next video, I'm gonna be looking at this incentive a little bit more in depth and looking at some limitations that are inherent in the incentive. So please subscribe to this channel and hit that little bell icon to be notified of future episodes. Thank you very much for watching. Thanks for taking the time. And as always, be awesome, do good, and build wealth.